So in July, listings were down 5% across the country, but interestingly, they were up 9% in both Melbourne and Sydney. And it looks to us like Melbourne and Sydney are going to lead us out of the declining listings now because they led us into it. It would appear that the people who are coming to market, there's two categories here. There are those who've been sitting on their hands waiting for more stock in the market so they can find something to buy. We are definitely hearing that investors are continuing to exit the market. We're seeing roughly about 20% of all sales are investors selling, and only about 9% of purchases are investors buying. And we think that's investors who are deciding to deleverage with the interest rate increases, and also some deciding to vote with their feet due to the new legislation in places like Victoria.
REA is invested in the rental side of the market as well, and we saw rental listings lower over the year. Given we're now seeing investors as net sellers, as you say, how could that affect rental listings?
I think the rental market is quite dire, quite frankly. Rental vacancies are still running at historic lows. We've got increasing immigration, so the population growth, people are going to need places to live, and we've got investors exiting the market. We don't have enough new supply coming on in new housing and new apartment builds, and so I can see the rental shortage, which will lead to rent increases, becoming quite serious for people who need to rent. On the flip side, what we're seeing is people starting to reform share accommodation. We have a business called flatmates.com.au, which is the largest share accommodation site in the country, and it had a stellar year. It was our highest growing business. So people are clearly having to form share accommodation because they can't afford to rent on their own. And we are sort of hearing anecdotally that tenants are leaving and moving back home. So that is putting some stock back into the market, but the reality is the rental shortage is going to continue, which is going to put a lot of upward pressure on rents.
Higher interest rates are biting on the broking side of the business, with fewer people taking out loans and refinancing having an impact on commissions. We're certainly not through the fixed rate roll-off yet, so there's plenty of refinancing ahead. What is the outlook for Mortgage Choice?
We think Mortgage Choice is going to have a better year in FY24 than we currently had. It was a bit of a perfect storm for a broking business in that we saw transaction volumes fall during the year. We also saw the average amount that a consumer could borrow, like for like, fall about 30%. So we had smaller ticket sizes and smaller volumes, and that caused a lot of pressure on the business. We still saw our loan book grow, but we didn't have that volume throughput. I think as we move into this year, as you said, we've still got a lot of fixed rate loans coming off, which is an opportunity for us to help our customers refinance. And we do expect an uptick in the volume of transactions. So all in all, Mortgage Choice should have a better FY24 than the current year.
In this result, we've seen net profit down, Australian revenue down, and overall revenue pretty much flat. Given a lot of your business is at the mercy of the broader economic conditions, where are the growth opportunities in this kind of environment?
There are many and varied. So within our core business, our residential business, we put through an average 13% price increase effective 1 July. And we've also had a lot of customers sign up to our top tier product. So that's a high yielding product. So we'll get the benefit of both that price increase plus that higher yield going into FY24. We think, as I said, listings are going to be flat to marginally up, and so that's not going to be a headwind and may even be a tailwind. And if Melbourne and Sydney are stronger than the rest of the country, we get a yield benefit out of that. We've also got our Indian business. It grew revenue 46% in FY23, and we expect that to continue to grow strongly into FY24. Our data business is poised for good growth next year. It now has the most accurate valuation model in the country, and so it should continue to grow. The commercial market is still quite healthy, so we'll see more growth there. Probably the only segment that is going to struggle still going into this financial year is new house and land and development. The conditions there are not great. We're seeing approvals for new housing continue to fall, and we don't think that's going to improve anytime soon.
Are customers still willing to fork out for those premium products at a time when listings are quite subdued? We know there's plenty of buyers out there. Are they still willing to make that investment when perhaps their property is already standing out, given there's not much stock?
Well, the stock levels are recovering. We always say that our products perform better in a softer market than a hot market. If it's a softer market, you want your property to stand out. The reality is we drive the most leads from our products, and so having the best product on the number one site it kind of makes absolute sense in any market, but particularly this one.
What are you expecting for the current financial year for the housing market and for REA?
Well, we think we're back to a more normalised market, and you can see that in a couple of areas. Firstly, demand is very, very healthy. We have the best view of demand on our site. There's 12 million Australians visit our site every month, and we can see through our buyer inquiries what level of demand is there. It's been increasing since May and is well up on pre-COVID levels, so demand is strong. We've also got banks willing to lend. They've got good liquidity and they are willing to lend to consumers. So if you can get finance and you've got buyers, it's a very healthy market. And you can see that in the house prices. So, despite the dire predictions for house prices with the rate increases, they've been increasing steadily since February. And again, that's an indication of just how healthy the market is. So our outlook for FY24 in the housing market is a very healthy market.
Owen Wilson, thank you.
Thanks, Stephanie.